There is a saying on trading floors: the most dangerous time in a market is when nothing seems to be happening, because that is when everyone stops paying attention. That is when traders check their phones less often. That is when the position sizes get smaller and the coffee breaks get longer. And that is usually right before the big move. Right now, AVGO is that market. For weeks, it has been going nowhere. Up $3, down $3. The kind of chart you scroll past without even slowing down. The kind of stock that makes you think, I'll come back when something's actually happening. But here is the thing about markets. The move doesn't announce itself. It doesn't send you a calendar invite. It just happens. And by the time you notice something's happening, by the time it is exciting again, most of the move is already done. Let me tell you a story about springs. You take a spring, you press it down. The harder you press, the more potential energy builds up inside it. You can't see the energy. The spring just sits there, compressed, quiet, but it is there, waiting. And then you let go, and it explodes. That is what is happening in AVGO right now. The spring is being pressed. And every day that passes, the press gets a little tighter. Let me show you what I mean. Look at the volume last week. We were trading 23 million shares a day. Monday, 17 million. That is a 27% drop in activity. Most people look at that and see boredom. They see a stock nobody cares about. But I see something else. I see the sellers getting exhausted. I see fewer and fewer people willing to sell at these prices. I see the spring compressing. Now look at the range. 2 weeks ago, this stock was moving $15, $20 a day. Wild swings, panic lows, euphoric highs. Now, it is moving in an $8 range between the short-term line at $385 and the mid-term line at $393. $8 on a $400 stock. That is tight. That is really tight. And it is getting tighter every day because those two lines, the short-term and the mid-term, they're converging. The distance between them is shrinking. The walls of the range are closing in. That is the coil. That is the spring being pressed. Now, you can't see the energy in a compressed spring just by looking at it. It looks quiet, it looks boring, but the energy is there. It has to go somewhere. Same with the stock. All that energy from the sell-off, from the rebound, from the back and forth. It is being stored in this tight range, and eventually it is going to release. The question is, which way if the spring releases upward? If AVGO breaks above that midterm line at 393 and closes above it with real volume, then the coil resolves bullish. And the move that follows. Historically, these kind of breakouts from tight coils can run 10, 15, even 20% before they pause. The target from there would be the top of the channel at 438. That is about 12% from here. Doesn't sound like much, but on a $400 stock, that is almost $50 per share. If the spring releases downward, if it can't get through 393, and it falls back below the short-term line at 385, then the coil resolves bearish. The next stop is the recent swing low at 369.50. Break that, and there is not much holding it up until the low 360s, one direction or the other. The spring doesn't care which way you want it to go. It just releases. Now, what I find fascinating about these coil patterns is what they teach us about patience. Most traders want action. They want excitement. They want every day to be a big move. But the best trades, the highest conviction, the cleanest setups, they often come from the most boring charts, because the boring part is the setup. The boring part is where the risk-reward gets built. The boring part is where you prepare so that when the move happens, you're ready. I'll tell you what happened the last time AVGO had a setup like this. It was back in March. The stock had been range-bound for almost a month. Volume was drying up. Everyone was bored. Then it broke out. And over the next 4 weeks, it ran 22%. 22%. From a chart that nobody was paying attention to. That is the thing about compressed springs. When they let go, they move fast, and they move far. So what do? 2 ways to play this story. The first way, you try to catch the release. You buy the spring before it lets go. You get in around 392. You put your stop below 369.50, below the recent swing low, below where the coil would clearly have failed. If you're right, you ride the breakout. If you're wrong, you're out with a small loss. It is not for everyone. It requires being early. It requires being wrong sometimes. But when you catch a big one, it is worth it. The second way, you wait for the release to happen first. You let someone else be early. You wait for the daily close above 393 with volume. You wait for the confirmation. Then you get in on the pullback or on the next day's continuation. You miss the first $5, $8. But you know you're right. You're trading with confirmation, not with hope. Neither way is right or wrong. They're just different for different people, different personalities, different risk tolerances. But whichever way you choose, be ready, because the spring is compressed, the coil is tight, and one of these days, maybe soon, something's going to break. And by the time it is exciting again, most of the move will already be done. So keep watching, keep your list ready, know your levels. Because the most boring charts, they often have the most exciting endings. If you enjoyed this story, hit subscribe. More market stories every week. The free weekly story note is in the description. See you in the next one.